Two major deals have just reshaped the landscape where Bollywood meets music. Saregama India has invested 325 crore rupees in Sanjay Leela Bhansali Productions, securing a minority stake that could grow to majority control by 2030. And Universal Music Group's Indian arm has taken a 30% stake in Excel Entertainment, the studio behind hits like Gully Boy and Mirzapur. Universal has valued Excel at about $260 million. Now, these are transactions that bring music labels and film producers closer than ever before. But there are questions on control and on the future of India's entertainment industry. Are we witnessing the beginning of industry consolidation, or is this simply smart cost control? Is this about locking in IP at cheaper prices or building global distribution muscle? And most critically, will music labels now call the shots in Indian cinema? Listen on. It's Thursday, the 29th of Jan. I'm Anirban Chowdhury. This is the Morning Brief. Joining me first is Rajesh Naidu, ET's in-house film journalist and critic, to explain the financial mechanics of these investments and why minority stakes make for compelling business sense for music labels sitting on record cash reserves. Listen in. Hi Rajesh, very warm welcome to the Morning Brief. Always good to have you.
Hi, Nirmika. Thanks for having me.
Talk to me about the two deals. What do they mean for Saregama and Universal?
I think an appropriate analogy to describe these deals is it's like mutual fund investment. If you directly go to market, it's a very expensive affair and it's fraught with a lot of risk. But in this case, when you invest through a production house and acquire music assets and film assets, it's far more cheaper, both in terms of cost and also effective in terms of returns. Let's understand the factors which have led to these deals. In the past 5 to 6 years, it has been a very booming period for the music labels. Then a big lifeline came in the form of streamers, YouTube, and other digital avenues where music could be monetized. Because of these, the whole fortune of music label and the music industry changed. If you look at Saregama's cash on books, in the past 5 years ending FY25, rose from 9 crore to 543 crore. So it's more than 20% compounded annual growth rate. And that's the average.
And it's a debt-free company.
It's a debt-free company. In the context of this fact, music labels have cash on books, but they are looking for opportunities where they can have music rights at the same time exposure to film assets. We have to look at from the point of view of two variables. One is cost, another is return. If a music label goes and purchases or buys music in the open market, a film from small budget to big budget, music rights would cost anywhere between 6 to 33 crore. And if you go by such deals, especially in having a minority stake and with the production house, what happens is since it's a multi-year deal and multiple film deal, the cost gets reduced. Conservative estimates suggest that it's 30 to 50% cheaper. Now let's come to the return aspect. Today the way things stand, investing directly in film is a very risky thing, fraught with a lot of uncertainty because the whole dynamics have changed. There is so much uncertainty in terms of how a film would fare at the box office. So when you invest in a production house with a minority stake, the ROC, return on capital employed, is anywhere between 30 to 40%. But on films, it is 11%.
But I mean, the way I look at it is these are essentially investments into film production for making greater inroads into their music properties and into their IPs, or just locking chartbusters and IPs at cheaper price. Is that a correct way to look at it, or?
Absolutely, that's a fair assessment. The ambition remains the same to acquire music rights for a perpetuity. That's why these two deals make sense because they have come at a relatively lower cost and also the ambition is achieved in the longer run.
But why minority stake and how will this creep up?
I think they are evaluating the situation both in terms of how these production houses perform outside their usual IPs. In case of Saregama, they have an option to increase their stake from 28 to 49% to 51% by 2030. So the room is there for them to increase stake depending upon how remunerative the investment turns out to be.
Did it come as a surprise to you? Because when I read Saregama's last annual report, there's a lot of investment on content, obviously, I think around 10,000 crore, and on acquiring maybe regional labels, etc. But there's no such mention of such huge inorganic expansion, growth, and investment and acquisition. Did this come as a surprise to the reporters who were covering this?
I think this was in the works. Saregama itself had a film division called Udley Films that was not doing so well. In fact, its video vertical, earnings before interest and tax, was making losses. So these deals, this investment in Bhansali production, it was a natural step they had to take. I think it's a very interesting structure where each player would play on its strength. Sanjay Leela Bhansali would be stronger on creative aspects, and Saregama India is more interested towards music assets and promoting it across various digital avenues. So the point here is, in the long run, it is going to be more about how the music and film asset function. It's a very wholesome deal because it's not just about film and music asset. Whatever Bhansali production creates, it can be a web series also. So that's also a part of the future deal.
Thank you so much, Rajesh.
Thanks, Anirban.
For a deeper understanding of the deals, Rajesh spoke to Nirmika Singh. Nirmika helps us understand the fundamental differences between the two deals and what they mean for the industry. Listen in.
Hi, Nirmika. Welcome to the Morning Brief podcast.
Thank you for having me, Rajesh.
Let's start with the fundamental question. What is your assessment of investments of two labels in film production houses, Saregama India in Bhansali Productions and Universal Music in Excel Entertainment?
Well, the news media are making it sound like it's an industry wide trend, but it's really not a uniform movement. These are very differentiated, very fragmented moves that labels are making in the past few years to get more control over acquisitions, to control costs, also to find their own differentiated offering in the market. So, Universal's stake in Excel, of course, gives them a big edge over distribution. They'll have more publishing control, there is more catalog integration. They're saying that there's a lot of creative autonomy that's going to be retained. But then the universal head, Dev Raj, also is going to be sitting on the board of Excel. So we'll see how important and significant that move is. The Saregama Bhansali thing is a very different sort of model where they will acquire a majority stake and then there is plans to sort of actually make it a majority stake over the next few years. That is a very strategic move that helps you cost control because then what you do is that you do away with competitive bidding from different labels. So you've acquired at least the future business to exploit the materials that the production house would be making. So two very different offerings, two very different models here.
Right. According to you, what are the triggers for this investment?
Well, the triggers are a lot, of course. I mean, if you see Universal strategy in getting equity in a production house, the idea is to scale Excel sort of offerings globally because Universal Music enjoys that privileged position globally. So, distribution is a huge need for them. They're also targeting premium Bollywood here. And if you look at the deal closely, the idea may not really be growth because this sort of stake and this sort of acquisition doesn't really make a lot of, I would say, immense or extreme business sense. But what it does is that it controls costs. Whenever there's a music album that, say, a production house puts together, there is competitive bidding by different music labels who want to acquire the album and want to be able to exploit it. The music rights are structured in such a way that you're able to exploit it even beyond just the recorded format of the song that can be monetized live, and there are lots of licenses there that also bring you royalties. So there's a lot of money to be made across the spectrum. So this sort of acquisition, what it does for the production house is guarantees a beautiful, robust distribution model. Maybe sometimes the publishing rights, which means that they might own the content, but distribution, of course, is bolstered by a big player. If you look at the music industry, the age-old model of music labels acquiring artists and owning the material, that's getting actually unshackled, where artists and creative people are owning more and more of their works, and labels are coming in to distribute their works, which is
Right.
something that an artist or or a production house might not have as a privilege. So that's what's happening, and everybody's doing this according to their capital capacity, according to their geographic investments, and what they want to seek out of their general sort of positioning in the market, whether it's a Warner Music, they're trying to acquire as much catalog because catalog is gold and it will pay you forever. Saregama is doing a different thing. And Universal's doing a different thing. Sony, of course, has done so many different transactional partnerships also. So everybody's following their own sort of format, and there is no precedent for it, which is why it's a wait and watch situation. We'd love to see what happens in the next few months and years.
Right. There have been a lot of discussion around these deals. On the one hand, there is a school of thought which says that this may be consolidation of film production houses. Then there is another school of thought which says that this must be looked strictly from the point of view of music labels having a larger play in the entire entertainment ecosystem. How do you look at these different schools of thought?
I mean, I don't acknowledge speculation as much as I do facts and numbers and what those numbers mean to the business right now at play. So if you look at, say, Excel, right? They produce about 2 to 3 films annually, and say their estimated annual revenue is about 300 to 500 CR. And UMG has acquired, say, 30% of that. So that's about 90 to 150 CR. If you eliminate some cost control and eliminate the bidding wars, say they have saved about 30 to 50 CR. So the total, say, Excel deals contribution to Universal Music India's revenue is not a lot. It's about 12 to 20%. Now, this is not transformational. It's quite meaningful, right? Like a mid-teens percentage contribution is quite a lot, but it's not a core revenue driver. So what's happening right now is that people are touting this to be, oh my gosh, this is going to be such a growth burst and, it's going to really change and transform. It's not going to transform. What it does is that it actually puts in place these robust structures that will be difficult to break and also set a precedent. But bear in mind that these kind of partnerships can only happen when a shark like UMG partners with a premium production house like Excel. I cannot say the same will happen in another sort of universe. In fact, something like this has not even happened in Hollywood before, where a label has gone vertically down and acquired a stake in a production house. And look at the other side of the spectrum, right? Say a Warner. Now, Warner doesn't care about production houses right now. They're like, we're not going to look at film as much as we're going to look at catalog acquisition. And when they do that, then they are going all guns blazing, signing distribution deals. They recently acquired the Ultra Music India catalog. They have expanded their collaboration with Tips. In regional, they're super big. In live entertainment, they've invested in Skillbox. They're also supporting artists by investing heavily in the creator ecosystem. And that's a different strategy altogether. I mean, Sony had a transactional sort of deal with Maddox in 2024. And then Maddox did another deal with UMG just a few months ago. Look at T-Series. Now, T-Series already is a market leader, 35%. And they've been producing music and movies concurrently forever. They don't care. For them, this model has already been working and it's been working since years. So what I make of it is that everyone is looking at what their strengths are, and then they're seeing how they can quickly, in their own ways, monopolize. But what's interesting is that everybody sees this as a very collaborative thing. They know that if they've got to make money and they've got to monopolize, they've got to do it together.
Could you talk about the similarities and dissimilarities between these two deals? Like, how are they comparable and in terms of structure, strategy, and goal?
The UMG is a production house equity deal. So they're acquiring equity, but that doesn't mean that they have creative control, is what they're saying. They have board presence. They've also partnered with Maddox. That's a separate thing, but I'm just integrating it to, contextualize what UMG has been doing. The second one is your Saregama deal, which is a path to majority control. They've infused about, 300 CR into Bhansali. And they're saying that 325 CR. And they're like, here's the money right now, but we're going to be acquiring a majority stake in the next 4 to 5 years. So it's a multi-stage investment. What does that mean? That means that there is a long-term content pipeline and there's a cost control because they don't want competitive bidding. So the similarities here are in terms of competitive bidding, that they are able to mitigate competitive bidding by being their primary music label partners. The dissimilarities are that, Universal enjoys a beautiful distribution network across the world, which Saregama does not. So, UMG is able to offer that to excel. With Saregama, it's more domestic. And it's a partnership that is also similarly built out of ethos. When you look at the Bhansali ethos of cinema and the Saregama stronghold over the Indian market, it makes sense. Just like it makes sense for UMG to be partnering with Excel.
So here's what we know. These deals aren't a uniform industry trend. They are fragmented, strategic moves tailored to each player's strengths and ambitions. Universal is betting on global distribution and premium content, while Saregama is playing the long game with cost control and a path to majority ownership. One thing is clear. Music labels are no longer content to simply bid for rights. They're investing in the studios themselves, securing future catalogs, and reshaping the competitive dynamics of India's entertainment ecosystem. Whether this model scales beyond these premium partnerships remains the big question. But for now, the message is unmistakable. In the battle for content, ownership is the new strategy. That's it for today. You were listening to this episode on The Morning Brief. It was produced by me and Vinay Joshi, sound designed by Radhas Naik. A new episode of TMB drops every Tuesday, Thursday and Friday, wherever you get your podcasts. Also listen to Corner Office Conversation on Mondays and ET in the Valley on Wednesdays. Stay tuned.